Hello, welcome to another edition of Nucleus Investment Insights. We have Cameron Murray on today. We've done a couple of weeks of just looking at the latest things for superannuation and how you can avoid some of the taxes on that. I thought it well worth getting Cameron back again. Cameron's a very independent thinker in terms of the economics, and he's had a few goes at superannuation. So we've titled this The Dark Side of Superannuation. So I want to talk through some of what he's got to say about it, and then I want to go through some of the tips I've got and ran through in prior weeks about how to avoid some of the taxes. And not to say that you shouldn't do these. I do think it's worthwhile doing them, but we just want to talk about the society wide and whether these are sort of an equitable way for everyone to, from a country's perspective, that whether these are the best things to be happening. So with no further ado, thanks, Cameron. Welcome aboard.
Thanks for having me, Damien.
Yeah, so I might start. So we've had you on a few years ago. Oh, sorry, actually, I should just remind everyone, everything here today is general advice, not personal advice. If you do want personal advice, feel free to book in and have a chat with us. But yes, you've had a look in the past at superannuation and the cost of it. It's sort of touted as being one of Australia's great strengths. We've got this massive amount of money sitting in Australia, and we have, I guess, government figure after government figure talk about what a great job we're doing in terms of it. You've taken a different slant. Do you want to give us, I guess, the thumbnail sketch, and then we might dig into a bit closer about what some of the issues are?
Yeah, great. Thanks, Damien. Yeah, well, I guess we're talking because I wrote an article last week on fresh economic thinking, again, summarizing my views. And I think, the title probably helps give you my perspective. It says Retirement Rort. The economic case against Australia's superannuation orthodoxy. Actually, as you mentioned a few years ago, I wrote a report called Scrap Superannuation. So I've been digging into superannuation as a system for providing for retirement. And when you dig into it with the perspective that that is the objective of this system, what you find is that the way it's designed and the principles behind it don't actually meet that objective at all. In fact, quite often it can make retirement more difficult because of the way it's structured, and it comes at a cost of making people poorer when they're young and they need the money so that they can be richer when they're old and don't need the money. So that's sort of the big picture, and there's a lot of detailed points as to how I've come to that view. And it's not like I grew up hating super. I have multiple economics degrees, and I was part of that. Yeah, saving for retirement's a really good thing. It actually took me quite a while of digging into it to realize that it's not fulfilling what we think it fulfills, and it would be better off just getting rid of the whole system if we want to make it easier to pay for people's retirement.
Okay, so let's start about the costs. I think so. So one of the big ones, and as I sort of said in the pitch, is there is some significant cost savings, tax savings that people can make by using super. How much of it is it costing Australia in total, these tax cuts?
So there's sort of two ways to think about the cost of super. There is the economic cost, like how many resources, how many people work in super that could do other productive things with their life if we didn't have a superannuation system and make us all better off. And then there's the budget costs, like how does it affect the government's budget balance of tax revenue and spending? So extra tax revenue from the incomes and assets that are being shielded in super, and extra tax spending from the age pension. So let's maybe start with the economic resources. The total fees for super sort of represent what we're paying for people and their offices and all of the accumulated resources, and that's around 30 billion a year. So that's about $3,000. No, sorry, $3,000 a household. Yeah. Oh my God, I've just realized how big that number is. Because there's around, good rule of thumb in Australia, there's 10 million households. Well, there's 11 million now. So $1 billion per year is around $1,000 a household. 10 billion is around $1,000 per household. So superannuation fees around $3,000 per household. Now, obviously, that's unevenly distributed. The people with lots of assets are paying more because they get lots of tax advantages and they're doing tricky things. in terms of that resource use,
And
is
we're just
also
talking about
around.
before sorry, as well, Cameron,
Yeah,
that probably doesn't include a lot of advice, a lot of the advice fees. Like that, there might be some advice fees in that, but if I go to a financial planner and they knock up a $5,000 plan for me, and show me how to save, 30 grand in tax over 10 years for my $5,000, that probably doesn't appear in those numbers, or at least most
yeah,
of it wouldn't appear. It would be my
mm,
guess, probably 25%
yeah,
maybe. Yeah.
yeah. You're right. So a small fraction will appear in the actual direct
Mm.
super fees, and you've got to remember that a lot of financial advice is still going to be done without the super system, using other types of structures to
Yeah.
minimize tax. So there's probably a little bit more on that.
Mm.
But I think the interesting thing is to convert that number into a human resources number. And if you find the best data we can, there's about 50,000 people working in superannuation and subsidiary sort of entities. Is that a lot? Yeah, that's about as much as the whole military in Australia.
Mm.
So we've got a whole second army of people. I call them like the spreadsheet army out there juggling the
I take no
same
offense to any
assets.
of this.
Yeah. Uh, look, I don't make the rules. Like
No, no,
I'm very
I am.
much, if you want to
I'm,
change the rules, you argue for it, but you play
yeah.
by them while we have them. Otherwise, the system doesn't work. But
Mm.
yeah, so we've got all these people, and you might like to hear this. They're pretty intelligent people who could do very productive things elsewhere in the economy, I would
Mm.
say, on average. So you've got this real resource cost, and that's pretty big. And people go, oh yeah, super fees are low compared to the amount of assets in super. I'm like, yeah, but you can't compare a flow to a stock, right? Because the pension is a flow per year that we spend, and the management is so small.
Mm.
We're talking about, so for example, the total Department of Human Services, for example, costs around 6 billion in administration, so around a fifth. And that does all the difficult welfare programs, that it manages all of those difficult things, and it only has 30,000 people across the state managing every unemployment benefit, pension, family payments, you name it. And it's way, way cheaper than the super system, which, what does it achieve for us
Yep.
collectively? Well, it doesn't actually take that many people off the age pension.
And,
Let me
I'm
give
pretty
you
sure
some.
the average wage of somebody in the public service is a fair bit below the average wage of somebody in the superannuation sector. Yes.
Yeah. Well, that's
Mm. Even if
definitely
you're not talking
true.
numbers.
Although
Yeah.
they might have other expensive overheads. But so to give you some kind of figure, Australia spends about 20 billion on electricity per year. That is for the whole thing delivered retail price.
Mm.
So we spend 50% more just managing the superannuation in administrative costs than the whole electricity supply to the whole country, right? And of course, people think we're wasting billions in renewables and this and that, and overbuilding transmission and gold plating that. Guess what? All of that added together, the gold plating plus all the rest,
Mm.
is a third less than what we spend on super. And so in terms of the scale of the total economic cost, super is like up there with the NDIS, which is one of the biggest rorts going. But the NDIS only just recently surpassed super in its total cost. And
Mm.
remember, the total cost of the NDIS delivers heaps of stuff to people. The administrative cost of super doesn't really do much good at the end of the day for everybody collectively. It saves a lot of tax for some people. Some people who don't trust themselves to save, maybe they think it's a net benefit, but maybe we can talk further about that. So it's just a massive number, and I
Yeah.
don't think people appreciate it. They go, oh well, there's 4 trillion in super, so 30 billion is a small number. You're telling me 3,000 a household per year is a small number for an administrative cost?
Mm.
No, it's not.
Okay, so that's the administrative cost. Then there's the cost of all the tax cuts.
Tax cuts. Well, these are actually a little bit
Oh, sorry.
tricky. So the lost tax revenue.
Lost tax. Yes.
So we've got this tax revenue side. How much do we lose because people put into super in pre-tax income? There's discounted taxes on accumulation, all these sorts of tricks. Like, it's so complicated. I just don't even try and keep up. You're the expert on this.
Yeah, we'll run
But-
through some of those a bit later. Yeah.
But Treasury reckons what's the number here? Treasury reckons it's around $40 billion in tax that is reduced because of the existence of the super system. Now, I actually suspect it's slightly less than that, because if it wasn't in super, it wouldn't be like full marginal tax on income, because a lot of the tax reduction in super is already from some kind of tax advantage structure. So I think it's probably less, but we're talking again a few $1,000s per household per year in lost tax. And guess what, right? That 40 or $50 billion in lost tax, the whole age pension on the other side of the spending, the whole age pension, all that cash paid to pensioners every year, 60 billion, right? So we're giving up $40 billion of revenue and we only pay 60 billion in pension. So, had we taxed super normally, we could have pretty much paid for a 50%, 70% bigger pension.
Well, and from what you're saying is, if you took your 40 billion and your money to run this of 30 billion is we could double our pension and let them run it, and we'd be no worse off, possibly better off in terms of
if we're talking macro,
from
right? That's right. Of course, the distribution of who benefits from each system is totally skewed, right? The people who benefit from the age pension basically don't get any of the benefits from super, and the people who benefit from super don't get any of the it's completely separated in terms of the distribution across households. But in terms of the lump sum in the aggregate, it costs us more than the pension. So we've got a system that costs us more than the pension to do what exactly? Reduce the age pension by maybe an incremental amount, which is what Treasury forecasts. Because remember, superannuation is skewed in exactly the proportion, or in fact more skewed than the income distribution of households during their working life, right? The benefits of superannuation. And so most of the superannuation system goes to people who were never on the age pension and who would have saved anyway, right? So it's not like the system gets lots of people off the age pension. There's just a small shift in the middle of some people who wouldn't have saved as much, and they're lucky that they were forced to, and so they can live a bit on their super for 10 years before they get the pension. And we're paying more than what the age pension costs for that tiny change.
Yes, and that comes down to the I guess one of the problems I often see is the whole idea of the financial literacy side. Is we're effectively saying to people, to everyone, hey, you know what? You now need to work out how to. We're not going to give you a larger safety net. Where you got to save this money and work it out how to spend it, and so you won't go broke in your old age, and that causes serious financial concern for people, and a serious, I guess, psychological concern for people. And I look at some people who are going to be fine, but they're really nervous about the whole thing. They're like, oh no, I don't know if I'm going to run out. Will I be able to survive? Am I going to be? I'm going to have to rely on my kids and all this stuff like that. And it's like, well, it's that extra level that if you just had a bigger safety net, maybe they wouldn't have to worry as much.
I think that's a really interesting point, Damien. The premise of super is people are too dumb to manage their own money while they're working. But they're also so intelligent that if we force them to put some money in financial markets, they'll be so smart that they won't make stupid decisions with that. And when they're 60 and they can take everything as a lump sum, they won't lose it all gambling or on a romance scam or whatever else pensioners are losing money on these days. And in fact, the incentive is to do that anyway. The incentive is to remove all your money from super and get the age pension. Give it to your kids, do whatever. I do find that that's another odd thing, but I just wanted to pick up on your point that we've got this schizophrenic view of people's capacity to manage their finances. You're too dumb, can't save for yourself. You're so smart, you know how to invest this lump sum of savings, which is it.
Yeah, and you know exactly how to pick the right managers and all that type of stuff. And so there's obviously that's a whole art in itself that nobody really, I think even the best people don't have a good explanation as to why managers outperform. And they're all sort of, I see studies about what type of car does your manager drive, and has he had a divorce, he or she had a divorce in the last few years, and stuff like that is about performance. There was one came out from China last year, maybe 2 years ago, about whether showing that ugly fund managers outperform good-looking fund managers, and so there's all this clutching at straws as to what is the right thing for it. So yes,
that's hilarious.
Yeah. And the other thing, so obviously, you've spoken a little bit about the sort of true origins of super as well, in terms of not really being really being something about trying to avoid inflation when it first started. I think that was you, wasn't it? Rather than being
Yeah, so
this
it's
this
quite
fantastic
interesting. Yeah, yeah.
long-sighted view about how to properly save for a retirement system.
That's right. I think the whole retirement story of super is a little bit backfilling to justify an accidental policy that sort of got a life of its own. So
Mm,
super had a couple of motivations in the 80s. One was to reduce inflation, which they said we want to make people poorer temporarily so we don't get inflation. And in a way, that also um, undermines one of the stories we now tell about super, that, oh, if people save more, we get more investment and the economy grows faster.
mm,
Okay, you mean the system we specifically created to stop people spending money to slow the growth of the economy actually now magically does the other thing because we like the tax benefits of it now?
mm,
Like, and the other interesting motivation for super was Paul Keating was very worried about the current account deficit, which is essentially the gap between what we import and what we export. And that gap is filled by foreign investment, essentially. So if we import more than we export, well, we have to pay for those imports by selling local investments, property, real estate, shares, etc., to those foreign owners. So it fills that gap. And in the 80s, there was a real concern that the current account was terrible. It needed some active change. And the theory at the time in economics was that um, savings by households somehow forces a different balance in the current account. There's this magical mechanism. If we can force people to spend less than they earn,
mm,
we will magically fix this. We had super for 30, 40 years. Nothing happened to the current account until the 2010s mining boom, right? Nothing, nothing changed. And now the economic theory has moved on in two ways. One, it doesn't care about current account deficits. I mean, they're balanced by investment flows. Unless there's a security risk, then you don't worry.
mm,
And secondly, we don't think forced savings does it. What can manipulate it is forced purchases of foreign assets, right? So the central banks can change it by buying lots of currency of a different country, reducing their currency and changing the balance a little. But so we've sort of moved on from all these purposes of super, and now we've just changed our story. And it's funny because a few years ago we were trying to legislate the purpose of super, and no one kind of wanted to, because we thought, oh, we'll actually have to think hard about what it's doing. And if
mm.
it's to, if you legislate a purpose to have financial security in retirement, it might require people to use their super to buy a house, because guess what the best asset is to own in retirement? A house. And if you're legislated to do the right thing for retirement,
Mm.
then maybe we'd have to change how we function. But so many people like it how it is, so
Yeah,
we don't.
and I just want to clarify. I think what you're saying when you say the best asset to own in retirement is a house is more about saying that gets excluded from pension calculations. That gets excluded from things like your thresholds. Like even if I was just over some of these thresholds and I'd use some money to buy a house instead, or to even just to put extensions and upgrade my house. All of a sudden, I'm below the thresholds. I can start to get some of these other
Yeah.
pensions and other things like that, or financial
So the
benefits.
assets test, yeah. So your own residence is excluded, right?
Mm,
So there's that, and that's a big one. But the second one is really security, right? If you're renting in retirement,
mm,
um, you'll get pushed around. You're exposed to the vagaries of the rental market in your neighborhood. It's the last thing you want to be doing is being forced to move and pack up your life stuff in
mm,
retirement. Maybe some people like that, and that's fine. They can do it. But the combination of the exclusion from the assets test and that security blanket, and because it saves you the rent, so that's kind of an imputed rent
mm.
tax-free income as well.
Yeah.
Those
and
those are the
and
main reasons.
the extra level you get is if you are renting, and you sort of, they do give you some credit for it, but the credit's nowhere near what the cost of housing is.
Yeah, I mean, if you want to live out in the sticks in a rented, cheap farmhouse in the middle of nowhere, maybe that's fine. But most elderly people like to be near hospitals and families and stuff at some point.
Yes. Now the other thing, so this I spoke a little bit about the financial management side of it, and that's where if you're rich and you can afford financial advice, because you're going to spend $5,000 on financial advice, and you're going to you can see where you're making a huge benefit. Whereas arguably for the people who are most on the margin of it, and are a few $100,000 of super, it just doesn't add up in terms of saying, yeah, I'm going to pay away 3 or 4% of my superannuation balance in order to try and get that benefit.
Yeah, exactly.
And then the last one, the tax side as well, just in terms of, if you're on 47%, you obviously save a lot more than if you're earning 30 or 40,000. I'll let you wax on that one. Yeah.
Well, I mean, yeah, it's mostly a tax break. I'll give you a little bit of some data here. So the Reserve Bank started analyzing superannuation back in the 90s because they obviously have a question around, is this system changing the savings rate of the country, right? And they found that in the 90s, about 3/4 of super was just a reallocation of savings that would have been made anyway, right? So it's just a reshuffling of a savings account into a super account with a term deposit in it, right? And then in the early 2000s, they came in and said, yeah, it's about half is just a reallocation of savings that was already made. So yeah, this tax break is part of that story that yeah, we were going to save, we just got taxed for saving that we would have already done, right? And so where's the social benefit of getting no result from a tax break, right? Because the saving would have happened anyway.
Right. Now I'm going to jump into some of our. I'm going to jump into a quick sales message first, and then we'll come back and we'll talk about some of these specific ones.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the other, actually, Cameron just reminded me, I missed something as well. The other one we want to talk about is just the idea of when you need your money in terms of, that's as you are retiring, you've often got lots of money, or a few years before you're retiring, you've got all this spare cash. Your kids have moved out, or your kids have stopped going to school, and all of a sudden money just starts appearing that you didn't even realize you had. And then you start shuffling as much as possible into super and save yourself a whole bunch of tax, which is great. But it sort of sits differently to how you are when you actually want the money.
Yeah, that's right. I think that's part of this, again, this misconception we have about what super's doing or what the problem is we're trying to solve with it. So there's probably this wrong perception that your people are young and rich and then old and poor. And that sort of sounds weird because everyone complains about boomers being so old and rich and owning everything, but that's actually the norm. Old people are much richer. And so if you think about, your optimal life, if I'm an economic, rational person and my income rises like this and then drops off, I want to redistribute from the future in my 50s to my 20s when my income's low and I've got a family of newborn kids to support at my house and I'm trying to buy a house. So the rational thing to do to smooth that lifetime income is to take money from when you're old and spend it when you're young. This is why we borrow money to buy houses. We take money from the future and we bring it forward to buy the thing we need now. That's why we have, HECS for university. We take our money from the future and we bring it forward. And then superannuation on top of this goes, all of that is wrong. Sorry, you should have less money now and put more back into the future when you don't need it. And so we've got a few perverse things. One is this idea of the income replacement rate, that super's trying to get everyone to replace 75% of their pre-retirement income. But for your average person, 75% of their pre-retirement income is almost the most money they've ever earned in their whole career, because their pre-retirement income is the peak. And you can go down 25%, but when you're in your 20s, you're below that already. Plus, you might have a household of 4 or 5 people you're trying to support, right? So you've got this perverse thing of super telling all these 20 and 30 something young families, I know you're really poor. This is the poorest you're ever going to be in your life, and you've got the most people to support. But guess what?
Mm.
You don't need your money now. You need it when you're old and rich and your kids have all
Yes.
left home. I'm
Yeah.
like, how does this make any sense? Right? Because
Mm.
when you're 60 and you can get your super, it also happens to be the peak age of getting an inheritance from your own parents.
Mm.
So you've got this perverse thing of having the highest income decade of your life in your 50s, getting your super when you turn 60, and inheriting money at the same period when you don't have any kids to support.
Mm.
And the opposite when you're in your 20s. And so what you find, if you look at the data on household net income adjusted for households, people in their 20s and 30s are poorer, right, than they are in their 60s.
Yeah.
And we are creating a system to make that worse, to make you even poorer then, to be even richer later. And you can understand why young people are frustrated these days, right?
Yeah.
Oh, I've got to pay tax. That's fine. Guess what else I got to do? Lose 11% of my money when I'm trying to pay off
About
my
to be
house
12.
and
Yeah.
12. I
Yeah,
mean, it's
11 and a half,
ridiculous.
about to be 12. Yeah.
And of
Well,
course, like 17% of men die before they get the super anyway.
Mm.
So their families might get some, etc.
Mm.
But that's a big number of people.
Mm.
Anyway,
Well, and that comes back a little bit on the same bit. I'll bring forward one of these things I was talking about. Want to talk about in terms of savings is there's two savings for low income people in terms of co-contributions you can make, and you can also get a spouse contribution for low income and get offsets to your income tax. Is that if you go to the average person who's earning 30 or 40,000 and say, yeah, no worries, just stick an extra $3,000 into your super and we'll give you back this, $500 and something, they don't have they don't have that money.
No.
People who have that money is when you have one partner earning lots of money, the other partner not earning much at all. And so these are sort of, while they're touted as being, we're helping out the low income people, they're not really. You're just helping out people who, where you've got one partner earning lots and the other one, looking at home, sort of not helping out much at all. And so it's sort of that same part about we're trying to give tax deductions and tax benefits, which if you can take advantage of them, definitely do. Well, we spoke about it last week and I can show them again, but they're not there to help the low income people because the low income people almost by definition don't have the cash
need their money right now
to use it. Yeah.
Like, I mean, that's the whole point. If you're at the lowest income point of your life cycle, you need more money then. That's
Yeah.
not the time that you go, oh, great, I'll put $3,000 away for when? For when I'm going to have a higher income later?
For
Like,
50 years time or 40 years time. Yes.
Like, and so yeah, you're right. It's just a misunderstanding of the life cycle and the problem that we have, which is some people who are in poverty and retirement, guess what? They didn't work. They had disabled family they were looking after. They themselves were injured. They never, they live in an area that's really economically declined. There's lots
They
of
had traumatic
reasons, right?
events happen to them. Yep.
Lots of reasons, right? Everyone's got a story, and some people, have a pretty normal life trajectory, and something happens, and they divorce, and then they're taken for a ride, and then they get scammed, and then they just give up. Fine. But none of those people really benefit from super at the end, right? The age pension is what keeps everyone out of poverty in old age. And just a quick funny point. Do you know about the superannuation lobby, the Superannuation Council, I think it's called? It's relatively new.
I don't know if I've seen that one in particular. I know I've seen lots of stuff from superannuation lobbies. What are these guys?
One of their big sales pitches about how great super is they're like, oh, super doesn't replace the pension. Most likely you can organize your super so you still get it. And I'm like, wow, you're kind of admitting that you're not really in the business of protecting people from poverty and providing them an income in retirement. You're just gaming all the tax breaks and systems we have created. And that's why I end up coming down on the side of, well, let's just unwind the whole thing. Let people take their money out at a certain rate. It's 10 or 15 per year for 5 or 10 years, and then just convert everything else into some kind of managed fund that is exposed to the tax system as normal.
Yeah. Well, and I've spoken about this before, but I think and this is one reason why we keep saying, get your money into super and it's good for shielding from tax. People say, oh, the rules keep changing and there's always this stuff going on, and there's this $3 million and all this stuff like that. I say, take anyone who's complaining about the rules and ask them if they would have preferred to take that money out. So they will let you retrospectively take all your money out for the last 20 years, put it back into your own name, and we'll tax it normally, and it won't be in your super anymore. Not one of them will take that deal because they know they're getting a massive. What they're saying is, oh, I was getting a fantastic deal in my super, and now it's just an excellent deal. I don't, that's terrible. And it's like, so there's, it is a tax advantageous way to save, regardless of how, like, it's never getting to the stage where you're saying, you're going to pay more. Well, it's very rare circumstance where you pay more tax in super than outside super.
Yeah, I mean, exactly. And that's why people are very upset about this over $3 million sort of imputed return tax. It's called the tax on unrealized gains. And I can share my views on whether there's a principle behind that. Well, I guess the question is, well, if they're unrealized until you sell them, when you should tax them at the full rate the year you sell them, because that's when you make them. But if you want some kind of capital gains tax discount or, inflation adjustment for capital gains in general as a principle, forgetting super for the moment, then you are telling me that you actually earned those gains in those years back then. So either you earn them in those years and we can either, maybe you don't have to pay the tax, but we can credit the tax in that year and you can pay it up when you realize it, or we can create the liability. But you can't say, I earned it in that year, so give me adjusted for inflation, but also I didn't earn it in that year, so you can't tax it. Like, you got to pick one. But you as you would know, tax debates are pure self-interest dressed up in the prettiest stories we can come up with. Look, maybe there's better ways to tax and incentivize people keeping their super balances below 3 million. But I have no big issue. I mean, I saw an article today. Oh, people taking their farms out of their self-managed super fund to avoid this tax. I'm like, yes, that's what it's for.
Yes,
so you take your assets out. Like, why is this bad? It's like, oh, well, I'm not getting a sweetheart deal anymore. I got to tell a nice story. But that's life.
Well, and look how rough numbers say. Look, if you take the AFSA numbers about a comfortable retirement for a couple, you need somewhere between $2 and $2.5 million in stocks. You're going to get enough dividends that will cover that $70-something thousand a year, and that's going to be growing over time. And so you're basically saying, if you've got that sort of $2 to $2.5 million, and you're living in what they call a comfortable lifestyle in retirement, and that's $2 to $2.5 million for a couple combined, then you shouldn't be going backwards. Like, you should be able to live off your dividends and your balance grow. So to then say, oh, $3 million, I need $3 million, it's unfair that they're taxing me money, is that like saying, Anyway, I guess I wouldn't have a problem if you just said,
what you're saying there is 2 to 2.5 allows the balance to grow, and that's also not the intention. Is it declines to zero, because it's otherwise the growing balance just is inheritance, right? And again, you can avoid tax there. And just on that point with that comfortable retirement measure, I think it's really puzzling that we go, a couple who own their own home and have a car so what's the after-tax income of that sort of couple? It would be 70,000 after tax, basically, right?
That's 70,000 after. But in pension mode, you can put $2 million each in your, or 1.9 at the moment, about to be 2 million. So you can have $2 million each for each partner, and in your pension mode, tax-free. So
the income's from that tax-free.
The income's all tax-free in pension. Once you're in pension, so you're fine. Like,
so let's to be clear. If I was a household of a single earner supporting 3 kids, paying rent in a capital city, how much would I have to earn to be equally well off as that home owning pensioner who's got 70 or 80? I would have to be like a $200,000 household before tax.
Easy. Because if you just said, so let's say you've got $2 million each, and you're earning, 5%, you can almost get 5% from long-term government bonds at the moment. So, let's just say 6 or 7% is what as you're earning.
Yeah, so you've got 70 grand each, basically.
No. So if you had $2 million each sitting in your things, you're talking about 140 each. So they're probably earning 280,000 tax-free. You're gonna have to earn $500,000.
But that's a house. But I'm also renting and supporting 4 people, not 2 people, right? So we're now up to like $600,000 or $700,000. Now, if you think it's unfair that a young family renting in a capital city earning $600,000 or $700,000 should somehow pay no tax because they have a special magical bank account called superannuation on it.
Mm.
Like, we're so off the charts.
Yeah.
So anyway, again, I fall back on get rid of super. Like, all these people, get that cash out of this system, dissolve all the accounting rules, and let's just tax
Tax them as
those
normal.
assets and those
Yeah.
flows.
Yeah. And
Because that's, that system is designed to be relatively equitable, right? You automatically get taxed more. Guess what? You lose money. Okay, well, I can deduct that loss from my other thing. Like, it works pretty well by itself. Anyway.
yeah. Yep. Well, I mean, I personally would love to see, my personal one is I'd love to see two different tax accounts. Here's my tax account for everything I've earned from earning. Here's a tax account of everything I've earned from just being an investor, with different tax rates on it. We can argue about what the right tax rates are, but keep them completely separate. And then in retirement, you can have whichever one you want. Choose whichever one's better for you. But you don't sort of turn around and go, somebody who's earning 200,000, for example, in pension mode, is tax free, and somebody earning $100,000 working two different jobs has to pay tens of thousands of dollars in tax.
15 grand or whatever it is, right? Like, it's a hell of a lot more. And again, the whole point is, the people who have those tax breaks already are the richest percent of household, or fraction of a percent of households. They already own their own home. They already have lots of assets outside of super. They don't have families they're supporting on average. I'm sure some do. And so, you're basically convinced me, Damien. I got to up my game here on my efforts to.
Well, let me give you some more. I'll give you some more of the ones we spoke about last week. So this is the one, the something catch-up contributions. So this is for people. Usually you do this when you're getting close to retirement. And so we spoke a little bit about just getting money into. Let me start back one. I'll start. So you got four different things. The first thing you're doing is reducing your income tax. We've already spoken about this, but you're either using a compulsory super, you're doing a salary sacrifice to get extra. And so the idea there is I'm paying 15% rather than whatever my normal tax rate is. So could be 47. You've got up to 30 grand you can do a year. But even if you go over that limit, you're only getting taxed at 30%. So even if you're on 47,
you still get 17% gain per dollar. Yeah.
And they talk about this section 296 or something as this is terrible thing. You got to pay this extra tax. The only reason why it's terrible is because what happens at the end, if you've stuck 10 grand extra, they turn around at the end of the year and go, oh, you owe me $1,500. And so it feels terrible because you got to stump up the money. But if you hadn't have put it into your super and you're on 47%, you would have paid way more than that. So, $1,500 is
still a deal.
Yeah, that's right. And then the other one is you can take money from your post that you've already received tax on, and put it back into your super if you're below the 30,000. So let's say you put 20,000 into super, and you can take 10,000 out of your savings, put that into your super, and then on your tax return, you can put it in and say, please give me my money back because I've put my money. Super.
So I'm just adding some more pre-tax to get up to the 30,000.
Yeah. So they'll sort of basically, if I've already paid 47 cents in the dollar. Okay, I'm putting it into my super. It's only 15. Give me back the 32 cents or whatever. That's the difference. And then you've got those low income tax ones. So that's saving money on tax. The second one is then getting more money into super. So getting this tax free. And so you can bring forward 3 years at a time. You need to be, there's some limits about when you can do this. You need to be sort of under sort of 1.7 million and all that, but the limit's pretty high. And so you can do 120,000 a year. You can shift from non-super into super. And with a 3-year catch-up. And so...
Hang on, what's the catch-up mean? I can put 360 in one go.
You can do, 360 in one go, And both partners can do this. So, you can do theoretically 720, and if you've got, if you've got a partner. So this is all about shoveling as much as you possibly can into that super and getting yourself up to that 1.9 million.
And will you do that in your 50s before you can get...
Yes.
Probably.
So you're basically saying you've built up whatever it is, and you can just shovel more and more of that cash back into super. And there's lots of other things you can do it for. If you're selling a business, if you're downsizing your house, if you've got a payout for disabilities, there's a whole bunch of other ones you can just basically use to shovel it in. And keep in mind that if let's say you're hitting some of these thresholds, so if you can shovel $100,000 across or 120 a year, and you might have otherwise paid 30% in tax,
Yeah.
on your earnings. So 120,000. Let's say you're earning 5 or 6% on that. So so it's that sort of eight grand. Say you might have paid in tax. Is that you can save? $8,000 you might have been taxable income. So you might have had like 3 or 4 grand of tax that you would have otherwise paid. So every time you do this, and you can do that every year throughout your 50s. So you can save yourself basically, 3 or 4 grand worth of tax per year just by going, for 10 years you can shovel it. There's like 30 grand worth of tax per annum. You can save just by shoveling this money across into your super as soon as you can.
And then when I've got it, I'm on the pension phase. The earnings tax-free into me.
The earning is tax-free up to 1.9.
Up to the
about to be 2.
So
for each partner as well.
So basically, I just cannot, like, when you talk about this, all of these tricks make sense when you're in that decade before retirement and your income's very high and you don't have a family. And I still can't fathom how people maintain this illusion that super is looking after people in their 20s and 30s and young families, right? Because they're losing, and they're losing 12%, and maybe they pay 40% in tax, but it's still money that they'd get then, right? And this is one of the arguments people say. They go, oh, but you wouldn't have saved if I didn't made you. Okay, but by not letting me get the money till I'm 60, you've undermined the whole benefit of this thing called saving, right? Saving's not just good. It's not a nice word. We don't like it for no reason. We like it because it provides a buffer stock for when life turns on us, right? We can do this. We can top up our income. We can have a year off. Someone gets injured, pay for this extra thing. Guess what? Super undermines all those benefits of saving because you can't do any of that buffer stock sort of drawing down until you're 60. And we know that that's a benefit because we have all these loopholes like, oh, if you're going to lose your house, then you can get it. Oh, if you've got a terminal illness, you can pay for treatment. Thanks very much. I would have rather had some amazing holidays and life experience in my 20s rather than wait till I'm 100% going to die this year to get my money back.
Enjoyed a holiday with my kids while I could do stuff rather than convalescing.
Imagine you're on your deathbed in your 50s. You're telling your kid, "Oh, I wish I had have saved more in super and had less money, and so I could, okay, the kids get the money and there's this inheritance incentive. I get it, but at the same time, your family's only young once, and people. Bit of a side note: if you look at people's memories of their lives, pretty much half your life is over when you're 30. Like those experiences when you're young create the memories that you enjoy for your lifetime. And then as you get older in your 40s and 50s, days are just blurs. You forget them. So if you look at a life and go, what were your happiest things? Right? Most of them, the halfway point is like 30, right? So most of them are when you're young, not when you're old. Anyway, bit of a psychological
that's note for me.
I know.
Okay, here's the other one then. So there's tax on inheritance. So so basically what happens here is if this is a compulsory part of your super. So if that bit I was talking about shoveling money into my super from non-super into super, if I die and then it goes on to my kids' adult children, that doesn't get taxed. That's fine. But the stuff of my compulsory one, so I've been paid $10,000 by my employer. I've got a tax discount on that. If I die before I've spent that, that's going to get taxed on my not on my spouse, but on my adult children at up to 17%. So that's and it's the idea that look, I should have paid 47. That was meant to help me in retirement. So now they're getting taxed on or something. So if you want to get around that though, what you do is once you hit pension phase, is you draw out that 120,000 a year and then put it back in again. And every time you're doing that, you are saving $25,000 worth of tax for your descendants. So and you can do that every year. So up to your 75.
Why does that exist? Because do you actually just transfer from bank account A to bank account B on Monday, and then on Tuesday you transfer it back, and then your accountant goes tick?
Yes.
I mean, is this a joke? This system?
Yeah, well, it's a loophole. It's a loophole
it's a loophole.
Everyone knows about, and nobody can be bothered to close because it's a little bit complicated, and rich people benefit from it, and poorer people don't. So, as with all tax.
Funny you say that, right? Like I'm good on the Labor Party for kind of having the right direction with tightening up the over 3 million balances and whatnot. But I do find it odd the political attachment the party still has to this system, right? So it's very hard for them to make big fundamental changes. And people with $2.9 million already benefited a lot, right? And they were already going to save anyway. So I do find it just this weird political perversion that the left party loves privatized retirement as much as the right party, but with
Well-
more tweaks, and the loopholes, maybe different people like different loopholes.
Yeah, but that's because if you're a part of the Labor Party, Cameron, I'll get you onto the board of one of these companies, and we know that we'll have captured super funds that are going to put money into owning projects, and there's a whole it's exactly so. And for anyone who hasn't known, I should have spoken a little bit more about Cameron's written a book a lot about this grey corruption that goes on in Australia.
It's called Rigged: How Networks of Mates Rip Off Everyday Australians. So you can go to Amazon, get Rigged. And yeah, you're right. Okay, so I mean I get it on a sort of more sinister economic view. I guess I'm saying I'm disappointed that that's where our left party has ended up, because there is obviously a lot of economic power from them and their unions controlling the allocation of funds from these compulsory savings, right? These super funds. There is real economic power there. So I get that. It's just disappointing, I think.
Yep. So that was our inheritance, and then the one which I do think, I'm supportive of. I'm interested to see whether you've got any downsides to it. So this is the first home buyer super saver scheme, which to make the whole thing simple for people is really, it's not about using your super to buy a house. It's about using the tax rate in your super to more efficiently save. So if you're saving, say you're on $100,000 a year, you want to save $1,000 a month pre-tax to buy a new house. If you're saving that, you would ordinarily, if you just got it in your own name, you'd start with 1,000, you end up with 680, and that's your savings. Whereas if you put in your super, you start with 1,000, you end up with 850. It's a 25% return on day one, and now that you pay a lower tax on that, and when you want to buy a house, you pull it out. The downside is you can't get it back if you don't buy a house. So if you do decide, actually, you know what, I'm not going to do that, or I'm going to move overseas, or something like that, it's gone. You got to use it for a house. But it's a very advantageous way of saving. I've got some downsides I want to talk about, but I might maybe throw across to you, Cameron, on your thoughts on it.
Yeah. So you're saying it's only extra above the compulsory rate
yes.
And this is an existing one. This is not what the Liberal Party were proposing.
No, this is an existing one.
Okay.
Yep.
I mean, I don't have any major concerns. It's a little bit, if you think about equality, it's people who were going to buy houses anyway, who are financially sophisticated, who will get this, who are going to buy houses anyway, right? And you've just given them money, which is sort of fine in a way. We give first home buyers stamp duty discounts and lots of other advantages to sort of give them a leg up ahead of sort of competing with investors in the same market. So it's kind of fine. As it is. I'm actually supportive of just I'm supportive of super for anything, which is not having a super system. But I'm also think super for housing in general is fine. Just take out your whole balance and pay off your mortgage, or use what you have as a deposit, because as I say, people who are young need cash when they're young, right? And the problem with super is you can have 200,000, or say as a couple, 300,000 in super, and a $600,000 mortgage, and you have to pay the mortgage, right? And people go, it offsets, and you want the high returns. I'm like, yeah, but the cash flow implication today is I have to pay that, and I can't get this back. So I'd love to cancel that out and take the cash today. So maybe the spouse, we can have another child, or take a year off work while the kid's are little, all that sort of stuff. So I think it's fine, right? And remember, houses are the best asset to own. So super for housing is also fine.
Well, this is part. I talk about to people about saying 6 to 9% is the sort of range you should expect in terms of equity returns in the long term. But it's wildly, it'll be 40% one year and minus 20 in the next. But if you're paying a mortgage of 6%, you're like, I've got a guaranteed negative outflow of 6%, or I've got a possible somewhere between 6 and 9 over the long term. It's like, well, why don't I just pay off the guaranteed liability?
And you might have a guaranteed 6%, plus your super might go down 20%. Because
Yeah.
if you're, if you're doing what you should as you're young, you should take those high risks because you've got the time, right? And
Mm.
you've just looked, oh, great, I'm paying this mortgage, plus I lost 10 or 15% of my super. What is the point of this thing, right?
Yeah.
And I think there's a few people thinking that right now, with the volatility in global share markets and the rising interest rates. I think there's a lot of people, I know personally a lot of people who are just, I want to just dump my super into my mortgage and get rid of this financial overhead on my life.
Yeah.
Um,
Yeah.
and I think it makes sense, and it's probably for the long run best for them, because if you've still got 25 years till you can get your super,
Mm.
well, you want to enjoy those 25 years. They're the best ones.
Yeah. Well, and the other one I do want to say, and I think you sort of struck upon this point about the people who are getting this first home buyer super scheme need to be financially literate, at least in some sense. And this is the issue I have, is that if you turn up to or one of your kids turns up to a financial planner and says, "Hey, I'm just getting started. I don't have hardly any money in super. I'm going to start putting away $1,000 a month, and then I'm going to have this whopping great mortgage for another 20 years. And then I might be a good financial planning client. Can you give me advice about how to do this?" They'll laugh at you. They don't want you as a client. Why would they want somebody who's that age? And so the bit where you're like, well, I could probably do need a little bit of advice, and that's where hopefully we're trying to do some type advice for people to help you into this, is that, it's a little bit complicated. The people who want to get advice basically can't, because financial planners don't want to borrow them. But if you're the son of somebody who's got tens of millions of dollars, and it's a financial planner that your dad's already got a relationship, or your mum's already got a relationship with, maybe they'll give you the advice to get you in. But it's sort of that same part about the people who it could most benefit are probably not going to get the benefit out of it, because they're just not going to.
I mean, that's true of every. What do they say? There's a saying that regulations are a natural monopoly, or the complex administration. So you make the rules really hard, only the most connected, well-informed people can navigate them, and it protects them from new entrants, right? So it's just another example of the same thing. Look, I've followed super for ages. I didn't really follow that Super Saver one. That's been around for a while, hasn't it?
A couple of years now, yeah. I think
like
4 years. Yeah.
I mean, it's fine, but it's all equivalent of just tax payments, right? It's just a creative way to give first home buyers a lump of cash, but make them jump a few hoops so that we only select those financially informed people. You could just also give them $20,000 cash when they buy a house.
Yeah.
Right? It's an equivalent thing, but everyone gets it.
Yeah. And I think that's the thing with a lot of super, is that it's a complicated way to give people tax credits. Because if I turned around and said, "Hey, Cameron, you're on 47.5% or 47% tax rate. You know what? Why don't I make it 15 if you want to save yourself some money?" Anyone who's, I'll give you like a 37. Here's your whatever it is. I'll give 32 cents back in the dollar. But mind you, if your wife's not working, or she's on, or your brother-in-law is on $20,000, he can save, and I'll actually tax him 15% for the benefit of saving.
Yeah.
And so you're like, well, that doesn't sound very fair. But because you've wound it up into super, and it could be complicated, is people don't understand. And so
you're right, Damien. You know what you're doing. You're convincing me to go and bloody minimize some tax right now. You're making me think the financial year's coming up. I'm gonna have to pay some tax. I should have been better shielding my income in creative ways. Although my main problem is I don't want it in 20 years. I want it now. So that is, in that situation, is very hard. To avoid paying some tax.
Yeah, but I think that's the thing for most people, is like there's tens of thousands of dollars worth of savings in here, and then think about, especially anyone who's anywhere near close to retirement, lots of different strategies you can use to get there. So take advantage of them. Hopefully, you'll use those tax savings to lobby to have some of these things, some of these tax cuts rolled back, so that we've got a little bit more equal. But I think that's probably a reasonable place to end this conversation. I might jump to you, Cameron, for some of where people can get more of your information and sign up to your Substack, which is great reading.
FreshEconomicThinking.com is where you'll find me. Put your email in, sign up for free, sign up for paid. There's lots of long reports on super, and you'll see charts of just how unequal or equal super is, and the life cycle of paying tax and avoiding tax. On Twitter /X, I'm at Dr. Cameron Murray. They're the main places. And of course, if you want to read the book about grey corruption and favouritism in Australia, it's called Rigged: How Networks of Mates Rip Off Everyday Australians.
Thank you very much, Cameron. Really appreciate you having on. Anything else you wanted to talk about? Otherwise, we'll just let everyone know if you do like what you hear today, click like and subscribe. You can get us on all the major podcast platforms. We go live on YouTube every Thursday at 12:30, and we're on a whole bunch of different social media: Facebook, LinkedIn, Instagram, X/Twitter. Feel free to follow us, and look forward to seeing everyone next week. Thanks a lot. Thanks, Cameron.
See you, Damo.